Everyone, and welcome back to Trading Simplified. Once again, every week I think I'm not going to do this, but this is our 21st episode. I don't know why I'm kind of giddy about that. Just time is just flying by. Well, last week and week before we talked about trades to traders, and I thought it'd be important to interrupt our regularly scheduled programming for how to survive a bear market through the portfolio ebb and flow. And what I want to do is take my model portfolio, which I put out publicly every day. And I want to walk you through that from the day before we started to sell off to the trough, at least so far, of the sell off. Then we could update that in coming weeks. And if we have time, we'll get back to trades to traders towards the end, but I doubt that we will because we got a lot to cover. And by the way, I do take requests. So if there's something you want me to cover, please let me know. I'm always looking for material. I have plenty of material to cover, but I'm always looking for material that's relevant to you. And then feel free to ask questions throughout this program, and I'll try to remember to pause if I don't get too busy with all the stuff that I have to cover to make sure I listen. If you're looking to get in touch with me, davelandry.com/contact. If you want the slides from this presentation, and then there's spreadsheets, and there's also going to be, I'm going to give you a plethora of stuff this week. Also going to be some trading, or a trading system in particular, and possibly links to other information. That'll all make sense towards the end. Go to davelandry.com/StockCharts. If you're watching live, give me about an hour or maybe even a little bit longer to put it all together. Okay, now I want to talk about market timing just real quick. I've spent many hours on presentations doing this in the past, so I don't want to reinvent the wheel here. But the first thing I think you should know is, make no bones about it, market timing is tough. You look at how many money managers can't beat the S&P 500, and you realize how tough it really is. What I would encourage you to do, though, is to find some sort of objective measure to help. I'm not saying follow these things mechanically, but something that'll help keep you on the right side of the market. For instance, hourly bow ties for the aggressive trader. Go back and watch, I think it was a third show or fourth show where we talked about trend transitions, and look at the hourly charts. And every major bear market, every major bull market will start with an hourly turn. Unfortunately, it's a little noisy. I've got a client that's in my Facebook group, and he's always talking about the hourly turns and on. He's like the first out of the market. Unfortunately, he does get a little whipsawed here and there. It's just a few days ago, actually 2 weeks ago, his wife was like, "Why are we 80% out of the market?" And the market began to implode. And then now she knows. Now, if you're a little bit longer term trader, then you want to look at daily and then weekly bow ties for a longer term view. The 10% TFM system, or TFM 10%, which we'll talk about a little bit today, and I'll give you plenty of links to many presentations. I've spent a lot of time on this system. Kind of amazed that such a simple system could work so well. Or even looking at the 50-week Landry light. Now, I'm working with a programmer to bring Landry light to you guys, and some of that code is already done. So I need to get in touch with David Carroll and figure out what can we release and when on that. And you'll see a little bit of that in today's presentation. Now, the main thing I would encourage you to do is let the setups and the ebb and flow, meaning taking initial partial profits and honoring your stops and trailing your stops lower. Let that ebb and flow control your portfolio. And that's what we're going to do today. We're going to start off looking at the portfolio, where it was the day before the market began to slide and where it was at the bottom of the slide. And I think you're going to find it fairly fascinating. Now, before we do that, the 10% TFM system, you're basically looking to sell when the market is less than 10% away from, you're looking to buy a market when it's less than 10% away from its 50-week high, and the last two lows are greater than the 50-week moving average. So you have 2 weeks of Landry light. That's pretty simple. Once you see it, it should be pretty simple, but I have plenty of presentations that talk about this. And then you want to exit when the market is 10% or more away from its 50-week high. That's a closing high, by the way. and the close is below the 50-week moving average. The sell parameters are a little less stringent to get you out of the way before it becomes too late. My thinking with all this, if you watch, I think maybe my first presentation that I've ever done for StockCharts.com, I talked about the ABCs of technical analysis, where if a market's at A, it's going to C, and B is somewhere in between, it's going to have to pass through B along the way. So what we're looking to do with this system is we're looking to sell when we're more than 10% away from the 50-week closing high and close below the 50-week moving average. And my thinking is if the market's going to drop another 70%, as you'll see in 1 second, which can happen, believe it or not. I mean, just look at the NASDAQ at 2000, it dropped 73%. And it was down 40 or 50% before it dropped even further. As I often say, it's often darkest right before it gets more dark. But these are the last few buy and sell signals here. And you can see we just got a sell signal recently. I think it was on February 27th, if memory serves. Yes, February 27th. Now, when I created the system, ideally, yes, I wanted to be buy and hold, but all I really wanted to do, or my main objective, the designer's intent, so to speak, was to avoid these diaper change moments where you lose over half of your account. So this column here, what I'm doing is I'm looking at the low of the move after you exit, okay? So if we look at this last little slide, since our sell signal on the 27th, the market has dropped 10% from that level. Now, if you look at the percent column over here, you could see that it was up 9%, but this number was actually much bigger before it began to drop. Remember, the system has to drop at least 10% on a closing basis, 50-week closing basis from a 50-week high, okay, before it can begin to trigger. Now, what's interesting is this morning I woke up and did a lot of research on this, and the TFM numbers look a lot better. They're not going to get any bigger. This is a long-only oriented system, but they're going to look a lot better as the buy and hold numbers get smaller. And I was shocked at how much these buy and hold numbers have dropped over the years. Now, it is a trading system, but I think it's pretty cool that it only made 11 trades in 31 years. And one thing that's also pretty cool is you're in the market a lot with this system, but you're also out a lot. You're out 6.34 years, or about 20% of the time, which I think is just really cool. So again, that number is going to look a lot better as the drawdown or the diaper change number increases. And one thing I did this morning was I went back to the early 1900s, so 20s more accurately, and we had a 83% drawdown from the sell signal. Obviously, that's the Great Depression, but it could happen. And again, as I often say, and I don't know who to give credit for this quote, but every asset class at some point in your life will lose at least half its value. And in my life, I've seen silver, cocoa, probably every other commodity you can think about. Stocks, I've seen stocks twice lose over half of their value. So it does happen, and it happens a lot more frequently than it should. And that's the old black swan analogy. Now, so how did the model portfolio fare? I have a trading service I put out every day. I give buy and sell recommendations along with the money management. So you could actually see, no questions asked, the methodology in action. So at the peak of the market, right before the sell-off, this is what the portfolio looked like. So to make the math work, a 1 is a long and a -1 is a short. And you could see that we actually, even though the market was going up, we did have 2 shorts. But Dave, why would you have shorts if the market's going up? Well, I look at the database every day. I look at a couple thousand stocks every day. And if I see some really good looking shorts, meaning stocks that I think are going to go lower, then I take them. So we had a couple of shorts in here. The open portfolio, now this is based on a 100K hypothetical model. Okay, although I do track this as close as possible with real trades to make sure that it's all working. So you'd have been up $19,155 on 100K. Now, if we look at these, we'll come back to that portfolio in a few minutes, but if we look at the positions, and a lot of these we discussed previously in the Trading Simplified show, so I'm not going to spend a lot of time harping on them, but the AUI was a TKO and it hit the initial profit target eventually. It took like 6 months for this thing to actually hit it. And there's a lesson or two in just following the plan in and of itself. And then we had a nice little rally coming into the slide. And then, of course, it sold off and stopped us out. So we made 1,000 on the first loaf or the first half of the trade and $400 in the second half for a total of 14. Now, remember the money management, we're looking to capture a swing trade. In this case, it took a little bit more than a few days, but we're looking to make a profit within a few days or hopefully no more than a few weeks and take those partial profits off, get our stop up to break even. There's a little bit more to the money management. So go in and watch the money management shows that we've done. And then hopefully, and I know I just said hope, but hopefully trail a stop higher and be with the position for a long, long time. So the AUI stopped out, which is kind of odd. You wouldn't think that a gold stock would stop out, but that's the kind of liquidation market we've been in. Now, tractor supply, and again, go back to prior presentations for more on this. I believe this was one of the mystery charts, which I will follow up on all those mystery charts in an upcoming show. But we had a transitional setup, which I call a first thrust, which again, I think I covered in show 3. There was a sell short. We hit the initial profit target a couple of weeks later. And then we held on since. And then this just barely nicked the stop. Now, I believe in applying a little bit of discretion. So it was only 15 cents over our stop at 100. In a case like that, it's okay to give them a little wiggle room and see if they sell off afterwards for something like a short. Now, you don't want to throw caution to the wind, but it's okay to give them a little bit of room. And I'll give you another example or two of that in just 1 second. But mechanically, as I am tracking this today, so nobody can argue that it didn't actually work, you would have been stopped out, unfortunately, right before that big old slide, which would have really, really helped out the portfolio. So overall, you made 1,000 on the first loaf. We're looking for a 1% move on the first loaf on $100,000. That would be $1,000. And then hopefully something much bigger on the second loaf, like you would have if you were able to ride out that little bit of a stop nick in this particular one. So that would be like another $2,200 or so on that. But again, we're just looking at things mechanically. This was a bit of a pioneer type of setup, meaning an early setup. The stock was just beginning to break down. It made what I call a first thrust. And some of these also, by the way, are bow ties. And again, go back and watch those early shows on this. So we had a sell short here. It didn't do a whole lot initially, but then it eventually went down, tagged our initial profit target, sold off nicely. A couple of retraces here and there, but this last little slide, it paid off nicely by sticking with the position. Now we take a look at PLMR. It triggered back here. This was kind of a TKO type of setup. We did a show just on that, so go back in and see that. I know I feel like I'm like last week at band camp, right? Anyway, hits the initial profit target. We trail a stop higher. Our stop ends up right around here. And then in this big market slide, it did go down and hit that stop. So $1,000 in the first loaf or first half of the trade and $519 on the second half of the trade. KOD, our big winner of late last year and this year. We had a buy signal, hit the initial profit target. And then we have a stop, which is coming dangerously close to today. In fact, right before the show, I actually had to go behind the curtain, the man behind the curtain, and put some stops in on this guy. What I find fascinating, though, remember, we're measuring from the peak of the market to the trough for this presentation on a closing basis. This stock actually went up. Now, this might not turn into a testament for following the plan, although I do have one IPO, which we may get around to next week or in tomorrow's week of charts, which I'll talk about, which actually took off in spite of this big old slide. So you never know which stocks may take off. I had one, I don't want to be the fish that got away, but I had one that I was long right before all this mess began to happen, began to unfold. And it turned out to be a coronavirus stock and it rallied 50 points. Unfortunately, it knocked me out first. So my point is that let's say you had 1,000 shares on, that'd have been $50,000. And if you would exited because you just didn't like what was going on or whatever and not followed your plan, you'd have been very upset. Now I know I'm kind of talking in hypotheticals, but what would the world be without hypothetical questions? So this is what the market did, and this stock somehow went up during that period. Now, there's no guarantee that it won't stop out, but sometimes you just want, or all the time, you want to follow the plan because sometimes these things will take off in spite of the market. So the market dropped 19%, and this stock actually ended up a few percent. Now, ping, we had a trigger back here and kind of a generic type of pullback, kind of a cup and handle looking setup. We hit the initial profit target. Our stop was here. And believe me, we're trying to make a lot more than break even in the second loaf. And by the way, take a look at this stop and look what the market did afterwards, or the stock did afterwards. It continued to implode. So that's why we do use stops. So if we add it all up, 1,000 on the first loaf and $353 on the second loaf. Now we're trying to make a lot more than just $353, or as in the prior ones, we didn't even have anything at all in the second loaf, okay? That's why we hold on for hopefully a longer term gain. And I'll show you. We'll take a look at that KOD again in the portfolio. PGNY triggers here, hits the initial profit target. We have a stop right around break even on this one. And then it goes down and tags a stop. And notice again, this stock continued to implode. So this is why we use protective stops. So we ended up with a little bit less than $1,000. And I don't know why it was a little less than $1,000, other than I think that there was a pretty big spread. And I used real trades on most of these. And in this particular case, it was a little less than 1,000. So I want to, even though it's mechanical, where technically it did hit that point, that initial profit target, I went ahead and marked what an actual trade would be. So you made 951 on this one. Now this one failed miserably. It's funny when I do a presentation in person, whenever there's a losing trade example, I said, I'm going to show you something that you've never seen. And the audience gets all excited and they all sit up and a few people wake up. And then I say, a losing trade, because no guru has ever showed you a losing trade. So IPT was up here off the chart, literally off the charts. We had a stop down here, and unfortunately, it did not work. But again, notice that it continued to implode after hitting my stop. Somebody emailed me and said they were very excited about my money management. I'm thinking, hey, I want to party with you. But all kidding aside, that's what I said, no, you're going to be a good trader if you're not already a good trader, because somebody comes up to me after when I present in person and asks me a money management question, I know that person's either made it or is close to making it, because everybody wants to know about setups and we're all setup junkies. But it's very important to follow the money management. So I was very flattered that somebody actually emailed me about money management. So we didn't quite lose the full $1,000 times 2, which would be 2% risk. And the reason is because we had trailed that stop up a little bit from the original levels. So that's a 1768 loss on that one. Q triggers here. We had initial profit target here. This is a biotechnology stock. And the stop is here. Now, let's look what happened. Notice it went down and kind of nicked that stop a little bit. Now, I'm not saying throw caution to the wind, but in this particular case, let's take a look at how it fared mechanically, okay? So mechanically, you would have made $1,000 and then 0 on the second loaf. But when I came in on this day, the bomb had already blown up, okay? Bomb's already blown up. The market's coming unglued. And little did I know that it would really come unglued over coming days or weeks. But that was a pretty ugly open, uglier than I've seen in a long, long time. And I said, well, you know what, Dave? This stock is probably going to hit that stop at least around the open. So what I do in a case like that is I give them a little bit of wiggle room below the stop. And then I have an uncle point in mind, meaning a point I'll get out, no questions asked. So when you're applying a little discretion like that, you don't want to throw caution to the wind. Now this is SPT. Again, profit target in this particular case was off the charts. Literally, stop was way down here. And unfortunately, it failed miserably. So there's another losing trade. And this one, we got whacked for a full 2% loss. 2% on $100,000 is obviously $2,000 loss. Well, it, pronounced with a, or spelled with a silent SH, happens. Now, we just got knocked out of a bunch of longs and one short, unfortunately. If you're not using discretion, the short stopped out. But what's kind of cool is we started seeing short setup. So here's ACGL, and these shorts begin to trigger. So we had a sell short right here. The initial profit target was down here. It triggers, goes down to initial profit target. So our stop is now at break even. So barring overnight gaps, which we've had quite a few of lately, we're in a pretty good position. The worst we could do is break even on the remainder of the trade. So mark to market, we're up 1902 on this one. And you'll see it in portfolio in just 1 second. BLDR, another short setting up. Nice little first thrust in here. A lot of these are also bow ties. And I have a template. I don't know if it could be shared, but I do have a bow tie template, and I'll find out. I'll talk with my producer, Rachel, after the show. So we had a sell short here and initial profit target down here. And it sold off nicely to hit that initial profit target. And once again, we're at break even. So we mark that to market. 1,000 plus 1256 equals 2,256. And this trade is still open, obviously. Okay, I've got 1 or 2 more shorts to go through. And then I want to take a look at the overall portfolio and see how everything turned out. Let's take a quick break, and we'll be back in just a few seconds. Okay, we're back. When we left off, we were talking about shorts, and we got one more to go through, and then we'll start taking a look at the overall portfolio. So this is AMD, and we had a sell short here right around 45, or exactly at 45. And unfortunately, the market gapped lower that day, so it did gap through that entry. Now we're following things mechanically, and so the entry is going to be down there towards the open, and we have a stop up here. And so far, this one hasn't worked out, but based on the mark to market, at the market low, we were down $64 on this particular trade. Now, the thing I preach, or trying to preach here, is the ebb and flow, and let the ebb and flow control your portfolio. So if we look at the original portfolio, we were up $19,155, and we were heavily, heavily long with only a couple shorts. And then the portfolio now is mostly shorts, and we're up 13,159. Now we do the math on that, and you can see we're down about $6,000 from that open portfolio snapshot to the open portfolio snapshot peak to trough. Okay, so let's take a look at something now. These are the trades we just looked at, including a couple losing trades. I don't want to just show you the winners, right? But if you add all that up, it comes to 3560. So you add that to the loss, and it's still a loss. I'm not proud of that, but it's a loss of $2,436. Now, getting back to the original portfolio at the peak, again, 2 shorts, and then 1, 2, 3, 4, 5, 6, 7, 8 longs. And 7 out of 8 of those longs stopped out. And we still have 1 that we're just kind of hanging on for dear life right now. And if we take a look at the current portfolio, now we have 1 long, again, that we're holding on to here. And then we have 1, 2, 3, 4 shorts. Now, remember, in the portfolio, we split up the positions. We sell short or buy the entire position at once, but we split it into a trading loaf and a trending loaf for tracking purposes. So here's what the S&P did over that time period, peak to trough, that we're measuring the day before the market began to turn down to the trough. And so far, because we don't know if it's over with yet, do we? As a trend following moron, I'm going to continue to follow it lower, right? So I lost in this model portfolio minus 2.04%. That's pretty good when you consider that the market lost 19%. Now, I think Greg Morris said this before, and I think this is where I got the line from. You can't eat relative performance. Like, in other words, if you're losing money, if you lost 50% of your account, but the market went down 70%, you still lost half of your money, and that's still a pretty big deal. So I think absolute performance is pretty dangerous. But in a case like this, only losing 2% and change versus 19% ain't that bad. And ain't that bad comes from kind of a quick story, a long story endless, I should say. Years ago, I had the brewery at my house, I had a garage with half of it was a brewery. And when I first started making beer, it cost a bloody fortune. And some guy at a crawfish party, hey, can I try one of your beers? I'm like, yeah, man. He goes, oh, that ain't too bad. I'm thinking that ain't too bad. Beers cost me about $10 a glass. Anyway, so that's where ain't that bad comes from. Not sure what that has to do with markets. Anyway, so the point I'm trying to make is, what does it look like when we go through a spill like this? And I hate to use the word hope, but hopefully, if the shorts continue to pay off and maybe that one little less leftover long takes off, we might get back in black from this whole deal. Like I said earlier, I got one IPO that's still doing really well. It's actually going up, and I actually took profits yesterday, believe it or not. So we'll see how it all works out. And that's something that I've been following up on in the weekend charts. Now, in an ideal world like 2007, it's funny. Everybody got caught off guard in 2008, and everyone made a big deal after the fact, said, oh, I called it long before it went over. And I'm thinking, no, you don't, Danny. But the thing that happened then was we were buying stocks the whole way up, and we were taking initial profit targets. And then I couldn't find a long setup to save my life. And all I could find was shorts. And I actually apologized to my clients for showing all these short side setups. And as the market began to roll over, we put on more and more shorts. We got stopped out of longs, and we ended up shorting and hitting those initial profit targets on the way down. And it was a very beautiful thing. Now, this one's been a little bit more abrupt, or a lot more abrupt, and we really didn't have a chance to get short until after this market had a really big slide. And that's just how the methodology works, because we're trading off of a pullback. But in an ideal world, and most of the time throughout my career, it's been a lot more gradual rollover than what we've seen recently. So what you want to do is you want to let that ebb and flow control your portfolio. So in summary, I would suggest that you have some sort of simple market timing system, and you don't have to follow it mechanically, but just have something that'll let you know if you're on the right side of the market. Obviously, honor your stops on the short side and the long side. You want to take partial profits along the way, because you never know when the trend is going to end. If you go back in and you look at a lot of those longs that we stopped out on, if you would have held on to them, even though we made money on them, you would have ended up at a loss. You want to listen to the database. If you're not seeing anything to do, then don't do anything. And if you're following on trading service, sometimes I'll go weeks without recommending anything. And I know that people crave action, and I know I'm going to lose clients, and it is what it is. And I have much longer stories about that. But I would much rather be true to form. And if I'm not doing anything, I'm not going to recommend that you do anything either. Now, if you have a plethora of shorts like in 2007 and you can't find a long to save your life, then you want to short. If you have a plethora of longs and little and no shorts, then you want to buy. So that's it for this week. Thanks for watching. May the trend be with you. If you need to reach me again, my contact information is www.davelandry.com/contact. And if you want the slides and some spreadsheets and a bunch of other goodies from this presentation, including the system rules, www.davelandry.com/StockCharts. So everybody, again, thanks for watching. Hang in there, guys. Honor your stops. Maybe pull off a short or two. And may the trend be with you.